The second type of ETF that you may want to consider investing your money in is a growth ETF, especially if you have more time on your side, because this is a way for you to get exposure into faster growing companies. Now, faster growing typically also means higher risk, but you also have higher potential for more growth. The reason why you want to have some exposure to growth, especially in this economy, is because, well, our economy is not projected to grow as fast over the next decade and couple decades as it has in the previous decades and the previous generations, just because our economy is so much larger now. Back in the day, in our parents' and our grandparents' generation, we saw our economy grow by 5, 6, 7, 8, even 9% a year. But nowadays, we're just trying to see our economy grow by 2% a year. So our economy, because it's so large, and our country, because it's so large, can't grow as fast as it did before. I mean, when you're a smaller company, it's not uncommon to see your company grow by 20 or 40 or even 100% in a year because you're small and you have the opportunity to gain a lot more market share and you can grow a lot faster. But if you're investing in just the biggest companies, well, you're going to be limited by how fast the economy can grow unless you're really investing in innovation. But if you're already so large, you don't really have the real need to be innovating and creating new products and trying to grow as big as possible, as fast as possible, versus with the growth companies and the growth stocks. These are the companies that are fighting, that are competing, and that are trying to get more market share. So these are the smaller companies that are trying to go faster, but that also means more risk, because now that means that these companies also have a bigger chance of failing and not succeeding. So instead of now you trying to find the right companies to invest in on the growth stage, you can invest in an ETF that will give you exposure to this type of growth. But again, you're going to want to pay attention to these 3 questions, because what you're going to see is that the ETFs that I'm going to go over here are very different than the ETFs that we just talked about that give you exposure to the S&P 500. Now, some of these ETFs are very different from the others, so let's go over them. VB is the Vanguard Small Cap ETF. So this is an ETF that gives you exposure to small cap, smaller capitalization, smaller companies, and you're trying to get more growth here because you're investing in smaller companies that are trying to go bigger. ARKK is going to be the only actively managed ETF. So this is an ETF that gives you exposure to innovation and is actively managed, not passively managed by a computer. Like the other ETFs that I just talked about is managed by someone named Cathie Wood and her team. She's kind of like a celebrity trader slash investor now. And this is an ETF that gives you exposure to more innovation and innovation type of companies. VUG is another Vanguard ETF. This is an ETF that gives you exposure to growth. This is the Vanguard Growth ETF, and this is investing in companies that are trying to grow bigger, faster. And then you have QQQ. This is the Invesco ETF that gives you exposure to the NASDAQ, and this is giving you exposure to the 100 companies, 100 biggest companies that are not financial. And so what that means technically is for most of these companies, they are tech companies, because the biggest 100 companies on the stock market that are not financial tend to be tech. They don't have to be tech, but most of them tend to be tech because besides financial, the next biggest industry of companies are typically in the tech space. And so QQQ gives you exposure to the biggest 100 companies that are not financial. Now, before we get into the questions, got to give you my disclaimer that I do own some shares of the ARK fund. So when we talk about who made these ETFs, this is Vanguard. This is Vanguard, this was ARK by Cathie Wood, and this is Invesco. All of these are very credible investment companies, and to see how much assets they have, let's look into each of their websites. So starting with VB, the small cap ETF on the Vanguard website, it says that they have $141 billion in assets under management. On the ARKK one, it says they have 21,000 million assets under management, which is 21 billion assets under management. The VUG Vanguard Growth ETF has 183 billion assets under management. And QQQ, I'm going to show you this on the finance.yahoo website because it's easier to find here than on their actual Invesco website. But if you look under the net assets number, it says that they have $192 billion in assets under management. So for all 4 of these, we know that they're made by all credible companies, and they all have billions of dollars in assets under management, which is significantly higher than the bare minimum of at least $100 million in assets under management. So we're looking good over here, which brings me here. What do they actually invest in? So starting up here with VB. Remember, VB is an ETF that gives you exposure to small cap companies. By definition, a small cap company is a company that's worth less than $2 billion. So now coming back to the Vanguard website, you'll see that their 10 largest holdings are things like the Biotechny Corp or Pool Corp or Diamondback Energy. Unlike the companies in the S&P 500 ETFs, which are worth hundreds of billions, if not trillions of dollars, those were companies that everyone has heard of. there's a good chance that you haven't heard of any of these companies because they're small cap and these companies are trying to grow. You can compare that to something like ARK, ARKK, which is investing in innovation. Here, this has a very different philosophy where Kathy Wood and her team are trying to invest in innovative companies actively, and they're trying to capture the upside that these innovative companies might have in the future, but it also comes with more risk and more volatility. Take a look. ARK's number one holding is Tesla. Then their other top holdings are Coinbase and Roku and Zoom and Shopify. Compared to the other passive ETFs, you'll see a lot more changes in the top holdings for ARK because it's actively managed. And so you'll see them change, which is a top holding. They'll buy and sell stocks a lot more often than these because all the other passively managed ETFs are just letting a computer do its thing. VUG is investing in growth companies, but more specifically, large cap growth companies. So this is investing in companies that have a market cap of over $10 billion. That's the definition of a large cap company. It's worth more than $10 billion compared to here. This is only investing in small cap companies. VUG's top holdings are companies like Microsoft, Apple, Alphabet, Amazon, Tesla, and Meta, which used to be Facebook. And then you have QQQ investing in the NASDAQ, which are the non-financial companies, and their top holdings are Apple, Microsoft, Amazon, Alphabet, Facebook, and Tesla. This is from Yahoo Finance. So VB is investing in the small cap companies, the smaller companies. This is investing in the large cap growth companies. This is investing in the NASDAQ, the non-financial companies, and this is investing in innovation. Now that we know what these ETFs are investing in, you got to understand the fees. Going back to the websites, VB's expense ratio is 0.05%, so essentially nothing. ARK's expense ratio is 0.75%, which is a lot higher than the others. VUG's expense ratio is 0.04%, and QQQ's expense ratio is 0.2%. So again, for these passively managed ETFs, the fees are pretty negligible because you're not paying for a person to actively manage and buy and sell the stocks, versus here you can see ARK's expense ratio is significantly higher than all the others. The reason being that this is an actively managed fund, and because of that, you're paying a higher expense ratio, and your goal here is to beat the returns of the market. But again, you're going to see a lot more volatility here. Some years you're going to see great returns. Other years you're going to see much lower returns. You might lose money. And so each one of these has its own fair share of risk, and you got to understand what your goal is before you go and invest your money into any of these ETFs. So now we talked about ETFs that give you exposure to the general economy and the general stock market, the S&P 500 ETF. This is an ETF. The growth ETFs are ETFs that give you exposure to growth and more innovation and more upside, because now you're investing in companies that are smaller, trying to acquire more market share. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.